Welcome to our channel on accounting lessons with worked out problems. Brought to you by an experienced accounting professor with a CPA. We have videos on all topics of introductory financial accounting. Our focus is on step-by-step illustration of a problem, worked out on a whiteboard. Each topic also reviews concepts at the end if you need to brush up. Please do not forget to subscribe. This video is on adjusting entries, recording adjusting entries, and preparing adjusted trial balance. Let us begin the video with a description of the problem we are going to illustrate.
So this is an unadjusted trial balance for Patel Delivery service on December 31st of 2023. So now, number 1 through 6, we have given some information to calculate the amount of the adjustment and the adjusting entries. So first what we will do is, we will open up an unadjusted trial balance showing all these accounts with the respective balances, and then we will show the adjusting entries, and then we will calculate the adjusted balance for each account. And then based on the adjusted accounts balance, we will prepare the trial balance. We will show them in the video in which this problem will be worked out on a whiteboard. This part of the video, we are going to illustrate the adjusting entries, and then here, as you can see in the board, we are going to use the 6-column sheet to do the adjusting process. This is the unadjusted trial balance, and I'm going to enter all the account balances that is given in the illustration. This column is for the adjusting entries, and finally the adjusted trial balance. And for each column we have the debit side and the credit side. Now I'm going to enter the unadjusted account balances. First we have cash that has a balance of 12,000. Accounts receivable balance was 80,000, and then we have prepaid rent that had a balance of 57,600, and then you have equipment that has a balance of 240,000, and then the accumulated depreciation for this equipment had a balance of 30,000, and then you have unearned revenue had a balance of 24,000, and then we are going to have an account called salary payable for 0. I'm doing this because during the adjusting we are going to need this account. And then we have common stock had a balance of 89,200, and then service revenue had a balance of 378,400. Salary expense had a balance of 120,000, and then you have the rent expense had a balance of 12,000, and finally we are going to also have a depreciation expense, a balance of 0, and then the total for the unadjusted trial balance is 521,600. Okay, so this is all the account balances from the unadjusted trial balance which was given in your illustration. Now we are going to go over the adjusting entries. We have some information for preparing the adjusting entries. So the first one, the equipment depreciated by $20,000. So we go to the adjusting entries column, we debit depreciation expense, 20,000, and then we credit the accumulated depreciation, 20,000. So debit depreciation expense 20,000, credit accumulated depreciation 20,000. Second information, delivery services performed, but it was unbilled and uncollected, and that amount to 6,400. So they have done the service, but they have not received the cash yet. So here you go to accounts receivable, you go to the adjusting entries column, so you will debit accounts receivable 6,400, and since they have done the service, you will credit the service revenue. You go to the credit side of the adjusting entries and enter this 6,400. And then number 3, 2/3 of the revenue received in advance has been earned by December 31st. So the amount received in advance, that is in the unearned revenue. It says the unearned revenue has a balance of 24,000 and they have earned 2/3 of it. So 2/3 of 24,000 will be $16,000. So they have done the service and earned $16,000. So what do? For the adjusting entry, you will go to the adjusting entries column and then you will go to the unearned revenue. This is a liability, you have to decrease it. So you debit 16,000 and they have earned this, therefore it goes as a credit 16,000. Next one, the prepaid rent was paid, the prepaid rent was paid on January 1st, 2023 for 2 years. And now we are doing the adjustment for December 31st of 2023. So 57,600 for 2 years, 1 year has passed. So they have used up 1 year worth of the prepaid rent, that is, which will be 1/2 of this 57,600. So this has to be decreased. So what do? You go to the credit side and 1/2 of 57,600 would be 28,800. You will credit 28,800 to the prepaid rent, and then you will debit the rent expense here. This is the rent expense, therefore you go to the debit side of the adjustment entry and debit it for 28,800. And then, since the last day, employees have earned an additional 2,400 which has not been paid and recorded. So here you go to the salary expense, it has to be increased. So now you debit it for 2,400 and you will credit the salary payable in the adjusting entry for 2,400. So now we have done all the adjusting entries. Now we prepare the adjusted trial balance. So cash, there was no adjustment, therefore that stays at $12,000 balance in the adjusted trial balance. And then accounts receivable, you started with 80,000 and then you debited by 6,400. So the new balance adjusted is 86,400. And then the prepaid rent, you credited or decreased by 28,800. Therefore the new balance will be 28,800. Now comes the equipment. There is no change in the adjustment. So that stays at 240,000. Accumulated depreciation started with 30,000 and we added another 20,000. So that adjusted balance for accumulated depreciation will be 50,000. Unearned revenue started with 24,000. You decreased by 16,000. Therefore, the new adjusted balance will be 8,000. Now the salary payable, it's at zero balance. You increase it by 2,400. The adjusted salary payable 2,400. Common stock, no adjustments. That stays at 89,200. Service revenue, you started with 378,400. There are two credit entries, that means we increased by 6,400 and also by 16,000. Now the adjusted balance for the service revenue would be 400,800. Now salary expense, you started with 120,000, you increased by another 2,400. The new balance will be 122,400. And then rent expense, you started with the 12,000, you increased it by 28,800. So the new balance will be 40,800. Depreciation expense started with zero balance, you increased by 20,000. So the new balance for depreciation expense is 20,000. Now you add up all the debit numbers and all the credit numbers. Now they should be equal. Now the total adjusted trial balance, debit column total is 550,400 and the credit column totals is also equal 550,400.
We just illustrated the concepts of adjusting entries, recording adjusting entries, and adjusted trial balance with a problem worked out in detail on the whiteboard. A review of the above concepts follows to help you brush up on them.
Now, what are adjusting entries? Adjusting entries are done at the end of the accounting period. Each adjusting entry will include at least one income statement account, that is a revenue or expenses, and one balance sheet account, asset, liability, or equity. Now, why do we need to do the adjusting entries? Because in accrual accounting, receiving cash and earning the revenue may take place at different times. The same way, incurring an expense and cash payment for those expenses may take place at different times. The revenue should be recorded only when it is earned, not when it is received. The expenses should be recorded when they are incurred and not always when they are paid. So when the cash payment, cash receiving, and revenue earning and incurrence of expense take place at a different time, we need to make the adjustments to appropriate accounts to properly measure the revenues and expenses. So here, the adjusting entry will debit at least one income statement account, because remember, we are either recording a revenue or an expense, and one balance sheet account. And adjusting entries do not involve cash account. Next, we go into the 5 major categories of adjusting entries. Number 1, prepaid expenses. Prepaid expenses happen when payments are made before the expenses are incurred. So when the payment is made, that payment is recorded as an asset. It can be a prepaid insurance or prepaid rent or prepaid tax. Now, this account, which is originally recorded as an asset, have to be adjusted, and the respective expense should be recorded when the companies actually incur the expense. So the amount of the expense must be transferred from the prepaid account to the specific expense account. So in this case, for the adjustment, we will debit the appropriate expense account and we will credit the prepaid expense account. Second one is depreciation. Now depreciation is a loss of the value of the property due to the wear and tear. So when you are using an asset, it is going to go down in value. Like what happens to your car as you drive for months and years, the value go down. So here, this is an allocation of the cost of the assets such as machinery, equipment, and building to an expense account, which is a depreciation over its useful life. So here the depreciation is not the exact expense. This is an estimated amount because no one can find out or no one can accurately calculate the exact amount by which the value of the asset goes down. So this is an calculated or an estimated amount. So here we debit depreciation expense and credit accumulated depreciation. Now this accumulated depreciation is called a contra asset account. A contra asset account is an account that shows the decrease in the value of the asset. So here, even though the value of the asset is decreasing, that decreased amount is not directly taken out of the asset account. Instead, it goes into a contra asset account that shows the decrease in the value of the specific asset. Number 3, accrued expenses. So this is the case where the expenses are already incurred, but they are not paid yet and not recorded. So here, since the expenses have to be recorded when they are incurred, we need to adjust the respective expense accounts, which are not paid and recorded. So we'll debit the particular expense account and we will credit a payable. Number 4, accrued revenues. These are the revenues earned but not yet received in cash or recorded. And revenues have to be recorded when they are earned. So here, to adjust the revenues, we debit a receivable and credit the revenue. The last one is unearned revenue. What is an unearned revenue? This is a liability account created when the company receives the cash from the customer or a client before providing the service or selling the goods. So once the cash is received, the company is obligated or is liable to pay back the customer in form of the revenue. This account is also called a deferred revenue. So when the revenue is actually earned for the cash previously received, the amount earned will be transferred from this account to the specific revenue account. So the adjusting entry for this will be to debit unearned revenue and credit revenue.
Thank you for watching the video. We hope the illustrated problem helped you to understand adjusting entries, recording adjusting entries, and adjusted trial balance. We have more lessons with worked out problems on financial accounting. Please do not forget to subscribe. We hope to see you in our next lesson.